Now, the AJ would normally recommend charging the 10% of the rent because it's more likely to be higher than 25% of the cost of the capital asset. So that is what he would normally recommend. Okay. Capital gains tax. Again, as we've already explained, capital gains tax is a tax that you effectively pay on the profit you make from purchasing a property for buy-to-let and then selling that property on, okay? The capital gain is literally the sale price less the purchase price less any indexation allowance, okay? So I'm just going to break down sale price, purchase price and indexation allowance, okay? The sale price achieved after deducting estate agent's cost, solicitor's fees and any other expenses that were wholly, necessarily and exclusively occurred in the sale of the property, okay? So the sale price isn't what you actually achieve, it's what you achieve less any costs that you had no choice, you had to incur those costs in order to sell the property, yeah? So that is the sale price. The purchase price is the cost of the property plus all survey and legal costs, okay? So, you know, if you had to pay out for 3 different surveys on that property, you incurred whatever in legal costs, that can be added to the actual purchase price itself to give you a realistic purchase price. And then indexation allowance. Indexation allowance is literally a multiplier on the purchase price that takes into account things like inflation and the fact that, you know, something you bought 1 year for 100,000, you know, 4 years down the line, 100,000 then is not worth what 100,000 was when you bought the property. So again, the government every year in the budget will put, you know, whatever the multiplier is to be on that, and you can use that to reduce the amount of capital gain you make.
Can you go back once again, please?
Yeah, of course.
Indexation, please.
On capital gain, yeah? The indexation allowance, yeah. What indexation allowance is, I mean, capital gains, you know, as we've explained, it's a tax effectively on the profit you make from selling the property, yeah? Now, every year we're running at inflation. I mean, I don't know what an average would be, I guess, if you worked on the basis that inflation runs at about 3%, yeah? So if you bought a property for 100,000, yeah, and 5 years down the line sold it for 110,000, while at first glance you may feel, well, yeah, you have made a profit, you made £10,000, that 110,000 factoring in the 5 years inflation may not be worth as much as 100,000 was when you bought the property. So to offset that, the government allows an indexation allowance. So every year they will allow you a couple of percent, whatever they set that limit at for that year, that you can write off against the purchase price to effectively reduce the profit and make it a more realistic figure based on inflationary factors, things like that. Any other questions at all on that? No? Sorry, go on. Fozia?
No.
Oh, okay. Sorry, Ben.
What happens if you actually, having taken into account all those things in the indexation allowance and everything else, you actually find you've made a negative profit? Can you offset that? Can you get tax relief to that effect?
I don't know my honest answer on that. I mean, obviously, if you've made a loss on something, you certainly don't have to pay tax on it. What I would say is if it's if you've just got the one property, yeah, then that's that. There's nothing really you can invest it, write it off against. If you've got a portfolio of 5 properties and, like you say, you make a loss on one property, then I'm sure you could show that on your books. And then, you know, if in the same year you dispose of another property that makes a £10,000 profit and you've made a £10,000 loss, then the two should be able to cancel each other out.
But if you've just made a loss, it just gets carried forward.
Yeah.
That must be quite a common thing. If you've got an indexation allowance that is something like the rate of house price inflation, and it's 10%, and you sell your house a year later for a 10% gain, then in real terms you've made no gain.
Yeah, absolutely.
So there's no capital gains
No.
tax to pay.
I mean, typically it more follows kind of inflation rates than property gain rates. Historically, property gain has been a lot more than inflation. Obviously, in the current market, that's not the case, but historically, yeah.
The indexation is the general rate of inflation?
Again, I don't know the exact way the government calculates it, but it's mainly done along the retail price index and general inflation costs rather than property. Because obviously capital gain is not just about property, it's about a lot of things, you know, from furniture, antiques, anything really, anything that you buy that then you later sell at a big profit. And again, you've got personal allowances, it's not, you know, a complete science, but just really trying to make sure that when you do work it out, that you have considered everything you had to spend in order to make that gain, and you have got yourself the necessary allowance to reduce it. Little things as well. I mean, if you live in a property and then after living in the property decide that you want to rent it out, you've got a 3-year period where that property is still exempt from capital gains. So things like that to bear in mind. Okay. How to reduce your capital gain? We've got the rollover relief, which is basically almost like you say, if you invest and then the money that you make from that property, you invest straight into another property, then that just rolls over, you don't pay the tax on that. Retirement relief, if you take the profit and invest that in a kind of retirement fund, then that becomes exempt from capital gains tax. And then the third and final, if you invest all the money in enterprise investment share schemes or venture capital trust schemes, that would exempt it again from capital gains tax.
Sorry, what was the third one?
The third one, venture capital trust schemes. Say they're not schemes that I've got great, great working knowledge of, but just be aware there are ways that you can, reinvest that money and not incur that capital gain. Sorry, go on.
What's supposed to do? There's three things you said.
Yeah, and the retirement fund as well. So yeah, basically, if you dispose of a property and invest the whole profit into a retirement fund, then you avoid paying capital gains tax on it. Enterprise investment share schemes or venture capital trust shares. I mean, like I said, they're not things that I've got great knowledge of, but enterprise investment share schemes, as it suggests, enterprise investment. So basically schemes to get, possibly small business, small enterprises off the ground. If you invest into that, they'll give you a break on it. Any questions at all on anything else that we've discussed regarding tax? Say, I'm not an expert, I'm not a qualified accountant, but it's just really doing the common sense things, making sure that everything that you are entitled to claim for, you claim. Paying the least amount of tax possible. Okay, excellent.